India and the United States are close to signing a major trade deal. The headlines are calling it a breakthrough, a win for diplomacy, business, and global cooperation. But behind those headlines, a different story is unfolding in India's heartland. Sugar mills and soybean processors, industries rooted in our rural economy, are growing nervous. Why? Because they fear this deal might end up hurting, not helping India's agri industry. This is more than just a trade story, it's a question of balance between global ambition and local livelihoods, between imported promises and homegrown industries. Let's break it down. Ethanol. India has made huge progress in ethanol blending, from just 1.5% in 2014 to over 10% in 2023. Sugar mills, especially in Uttar Pradesh and Maharashtra, have invested heavily in ethanol production, using sugarcane juice, molasses, even surplus grain. This isn't just about fuel, it's about giving sugarcane farmers a steady income. It's about reducing our oil import bills. It's about cleaner energy. But here's the problem. Right now, India protects its market with high duties. 150% on undenatured ethanol, 60% on denatured ethanol. If this trade deal cuts those duties, cheaper US ethanol will enter the Indian market, and that could undercut Indian mills and the lakhs of farmers who depend on them. Next up, soybean oil. India imports over 70% of its edible oil needs, mostly palm oil, sunflower oil, and soybean oil. Now, US soybean oil wants in, but India's soybean processing industries are already struggling. Our crushing units are small, oil recovery is low, production costs are high. Meanwhile, US processors are efficient. Their oil is cheaper, and if tariff is reduced, Indian processors simply can't compete. This could hit not just our factories but farmers, jobs, and local economies. Let's zoom out. This deal could deepen our partnership with the United States. It could unlock gains in technology, defense, energy, even pharmaceuticals. But every trade deal has winners and losers. And the question is, who in India stands to lose? Are we ready to open up sectors where we are not yet competitive? Should we risk rural industries that are just starting to modernize? Is this the right time, or are we just rushing? This isn't the first time such a dilemma has surfaced. In the 1990s, Mexico signed a NAFTA deal. Cheap US corn flooded Mexican markets. Millions of Mexican farmers couldn't compete. Many lost their farms. Could India face a similar fate in sugar and soybean? Here's the tough truth. Our agri-processing industries need reform. Modern machines, better logistics, higher efficiency, more government support, but instead of helping them level up, slashing import duties could expose them to unfair competition. So what's the way forward? It's not a binary choice. India doesn't have to say yes or no blindly. Here's what we can do. Retain tariffs in fragile sectors like ethanol and edible oils. Offer concessions in tech, clean energy, and pharma where we are strong. Invest in modernizing sugar and oil processing units. Give targeted support to help them scale up and compete globally. Because trade isn't just about imports and exports, it's about people, it's about survival. This trade deal could be historic, but it must be fair. If we allow US ethanol and soybean oil without safeguards, we risk hollowing out our rural economy one deal at a time. So, as India negotiates with the world, it must also negotiate with itself, between urban consumers and rural producers, between global opportunity and local capacity, between New India and Bharat. The stakes are high, let's choose wisely.